Financial management, understanding the links in financial statements. Welcome back behind my screen. What we did last time was we went through the different components of the financial statements, and we spoke about what were the goals of management, the agency problem, and the different forms of businesses, and the difference between financial management and accounting. What we're going to be doing today is taking you through how these financial statements talk to each other. We're going to unpack what's an income statement, what's a balance sheet, how they link together. If you have no idea about financial statements, you haven't come across income statements or balance sheets before, this video is specifically for you. And hopefully after this video, you'll be a whiz at understanding income statements and balance sheets. And that's the game plan for today. When we look at the financial numbers, you've got to understand that we look at the numbers differently for different occasions. Management accounts, as you know, is internally, and you're looking at the performance and planning of it. So you look at the performance and planning in terms of management accounts. When you're reporting to shareholders, you're reporting on what happened, but it's to external parties, and those are your annual financial statements. And then you look internally as well, but when you're looking at new projects, you're starting to analyze the numbers in terms of what we're going to be doing going forward and how sensitive are each of these things to different aspects of the business. And I say you need to use accounting to manage like a pilot. What do you think I would mean by that? Maybe this picture can help you. So here's a picture of a dashboard in an aeroplane, and a pilot is sitting in front of the dashboard and it has all those dials in front of him. The pilot can have a look at any of these dials and understand what's happening in the rest of the aeroplane. He does not have to get up and walk to the back of the aeroplane to see what is happening. All the information is fed to him in one place. And as you can see, some of these dials have a little bit of red and a little bit of green. And if you look at the green bit, if the dial is in the green bit, it's positive. If it's in the red bit, there's something wrong. As people in management, we need to create our own form of dashboard. And in fact, we call it a financial dashboard. And it indicates to us what's happening within the business and what is good and what is bad. So you need to decide what you're going to put on those dashboards. When a pilot gets into an airplane, the dashboard's there for him. When we get into business, we can decide which are the things we're going to focus on. What are those numbers that we focus on? And as someone said, what gets monitored gets done. And you need to decide what are you going to monitor so that it gets done. And you decide what those indicators are, and also decide what the traffic lights are, if it's red, green or amber, if it's good, bad or not so good. So you need to learn to manage like a pilot. There's some important concepts that we'll go over. We might have mentioned this in a previous video, but GAAP and IFRS. We used to report accounting according to GAAP, General Accepted Accounting Principles. We now report according to IFRS, International Financial Reporting Standards. These are just different ways of reporting the finances and have their own rules and their own layouts. The way the balance sheet used to be laid out according to GAAP is slightly different according to IFRS. During this course, I'll highlight some of those differences. We've also got the matching principle, which is a very important thing, and it relates to depreciation, which we will get to and discuss later on. But what the matching principle says is that you need to match your income and expenses to the period in which they're being used. In other words, if I pay for something today, but it's a payment that's going to last over 5 years, I need to split that payment over the 5 years. Double entry is so crucial to finance. The double entry bookkeeping system. Every single transaction has two sides, the in and the out. If I bought a car, I might go to my friend and say, hey, I bought a new car. I'm only giving half the transaction. What I should do according to accounting is say, well, car in, but money out. And the double entry bookkeeping system uses this concept throughout to make sure that we balance at the end. Now, accounting has its own language, and this is one of the limitations, one of the big limitations. We use terms that you do not understand. So you need to learn to speak accountanese, if you want to call it, the language of accounting. Also, you have terms that actually sound like English, but are not. Like turnover. Turnover in English means one thing, in accounting it means something else. And in fact, we have different terms that mean similar things, like turnover, sales, income, revenue. So we're going to, during this course, unpack all of those things so it becomes a language that you understand. Another limitation is that accounting can't show non-monetary information. If you've got something that you can't reduce down to rands and cents, you can't put it into the balance sheet. Like potential, like opportunity. Cannot put that down in the balance sheet. And then value shown is not necessarily today's value. Figures are approximations and may reflect opinions. Sometimes we have something that is worth something and it's written in our books at a certain value, and we know that at the market we can either get a lot more for it or a lot less than for it. So the value shown is not necessarily what the market value is, because we're using the accounts for a different purpose than for the market value. And again, we'll unpack some of those. So if these are the limitations, you might say, well, why do we need accounting? Because we use accounting to produce some vital information. We measure the amount and source of profit or loss, how much we made, and where we made it within the business. And was it a profit or was it a loss? We show the cash flow generated in the source, how much cash was actually generated and from where. Cash is different from profit. Do you know that you can make a profit and still go bankrupt? And you think, how can you make a profit and go bankrupt? And it's because of a timing difference. When I make a sale, we record it as income. But if I only get paid for it later, I don't have that cash flow. And if I get paid too late, then I run out of cash. And then we got the capital employed in the business. That's how much money has been invested in the business. And we record who owes us and how much, and who we owe and how much. Finance also gives us direction. When we're planning for something, how much do we need? How are we going to allocate our resources? Where are we now? Where are we going? What's our current status, etc. So we use finance as the overlaying layer of the whole of the business. And now what I'm going to do is a little exercise with you. And I'm going to simulate something that would happen in a face-to-face classroom. In a face-to-face classroom, I'd put this up and then I'd start asking questions and people would shout out the answers and I'd write them up. So I'm going to simulate this as best as I can. And I'm saying, we're starting a business. Where would you get money from to start a business? And you could say you get a loan. You get money lent to you from a bank. And then I'd say, where else could you get the money? Maybe you put your own money in. Not a bad idea. Where else? Investors. Yes, you can get a whole lot of investors. And the investor could put some money in. Is there anywhere else? We've got something called the 3 F's. The 3 F's, if you haven't heard of it, stands for friends, family, and fools. And it's just a term, I'm not sure where it came from, but it's a term that is used that means everyone else. Where did your money come from? Well, everyone else, the rest of that. It encompasses everyone else. And the last place you could potentially get money from is government. So you could get all sorts of funding, but the funding you get could be from these 5 main groupings. So we got some money. Now what do you do with that money? Where do you invest it? What do you use it for? And again, people could shout out answers, and I'm assuming somebody would say buildings. And so yes, you could use some of that money to buy buildings. You might not want to buy the building, you might want to rent it. What else could you use the money for? A car. And if you buy a car, you'd have to put petrol in it. So we'll record that as well. What else? Salaries. We've got to pay salaries. We might pay for some marketing. We definitely have to buy some stock for our business so that we could sell it. Buy some equipment that we need. Pay for maintenance. Pay a variety of fees. You might have lawyers' fees or accounting fees. We might have to buy some computers. So you are buying and doing all these things. So as we're going through this, these are the things that you might have called out. And then hopefully I'll make some sales. And now as you called them out, I wrote some of them over here and others I wrote over here. What was the difference? Why did I write some of them over here and some of them over here? What is the key difference between those two? And if you think of it, these things over here are things that I own and they got a value attached to them. I buy them, I use them, but even though I use them, they're worth something. The things over here are things that I buy and I pay for them and I use them, but as I use them, they get consumed up, they get used. So the things that I buy that have got a value attached to them, these we call assets. And the definition of an asset is just something that you own that's got value attached to it. What are these things, these other things that we pay for and they get used up? Those we call expenses. And ourselves, what do we call that? Well, that's money coming in, income. And this over here, where our money came from, well, those we call liabilities. And some people say to me, hang on a second, how can those be liabilities? In there is our own money. How can that be a liability? It's because you and the business are complete separate entities. If I own the business, but I take my money and I put it in the business, because it's a separate entity, even if it's owned by me, the business still owes it back to me. So I take my money and I put it in the business. If I look at it from the business's point of view, from their viewpoint, they owe this money back to where it came from, which is me. And so if we look at your income statement and you take your sales, less all your expenses, you could land up with a profit. If your sales are more than your expenses, you make a profit. But if your expenses are more than your sales, you can make a loss. And this, in fact, used to be called the profit or loss statement or the P&L. So this whole thing is your income statement. This is what we call the income statement today. And the other side, your assets need to equal your liabilities, because we say where the money comes from and where the money goes to. And these two things have to equal. And when things equal, we say they're in balance. And that is why this whole thing is called the balance sheet. So that's your income statement and that's your balance sheet. Your income statement just says where did the money come from in terms of sales and what expenses did we have. And if we're getting more income than expenses, we make a profit. More expenses than income, we make a loss. And your balance sheet tells you where did my money come from and where does it go to. And those two things equal. As you've seen already from the previous videos, the income statement has a new name under IFRS. It's called Statement of Comprehensive Income. Well, I'm just going to continue calling it the income statement. And your balance sheet also has a new name. As you've seen, it's called the Statement of Financial Position. But I'll most probably continue referring to it as the balance sheet. Now that you're okay with that, I'm going to go through this exact same exercise now, but I'm going to put numbers to it. So let's have a look at this in terms of starting a business. So I'm putting numbers to the previous information. Maybe we can understand it a little bit more. You want to start a business. Where can you get your money from? You go to a bank and they give you some. So let's say the bank gives you 100. Where else can you get money from? So you get some investors and they give you 100. And so now we have 200. On day one, where's that money sitting? Yep, it's sitting in cash or in our bank as an asset of 200. And our balance sheet balances. Now we need to buy some equipment. So we buy equipment of 100. Where does that money come from? It comes from your cash. And your balance sheet still balances. We might need a car. So we now get 50. We take 50 for a car. Where do we get that from? Also from our cash. Your balance sheet still balances. We now take some of this and we pay for salaries. And let's say the salaries was 35. Where does that money come from? Yep, from the cash. So now our cash is down to 15. And if we look at this side of the balance sheet, on the asset side of the balance sheet, it now adds up to 165. And your balance sheet doesn't balance. Your balance sheet goes out of balance. It's an unbalanced sheet. But don't worry about it now, because at the end of the period, we rebalance the balance sheet. Let's say that now we make some sales. And our sales are 60. Part of that 60, people pay us in cash. So they pay us 20 in cash. So our cash now goes up to 35. The rest they owe us. And what they owe us is the remaining 40. And we call that debtors. Debtors is money that is owing to us. It's not debt, it's debtors. They're different. We're going to talk about debt in a second. And now if I look at my balance sheet and I add it up, it still doesn't balance. If I add up all these, 35 plus 100 plus 50 plus 40, that comes to 225. And now the balance sheet is unbalanced. It was unbalanced the one way, now it's unbalanced the other way. But here's the trick, and this is an important trick to understand within this. At the end of the period, we look at our income statement and we take our income, in this case 60, less our expenses 35, and we get a profit. 60 minus the 35 is 25. Who does that money belong to? That belongs to the investors, and we take that money and we could pay it back directly to them in dividends. But if we are a growing business, we take that money and we give it back to them directly. And so this now becomes 125. And we add these two things up and it's 225. And now our balance sheet balances. So hopefully this is showing you the mechanism of how this works. And by the way, money that is lent to the business and you pay interest on it, that type of money is called debt. So instead of bank, I'm going to write debt. And money from investors is money that's put into the business and they don't earn interest, they share in the profits, and that's called equity. And so what we've got now is we've got our debt and equity adding 225, where the money came from, and the other side of the balance sheet, all our assets, and that equals 225, and our balance sheet balances. Just by the way, the assets that we've got here can be split into two types of assets. We got current assets, which is your short-term assets. Your current assets are short term. And in finance, when we talk about short term, we mean anything below a year. That would be short term. And our other assets, which are longer than a year, are non-current assets. So we could now split this up and change this, if we wanted to the total of non-current assets and our current assets. And as you can see, the long-term assets, things that we would have for longer than a year, would be 150, and the other bit, which would be our debtors plus our cash, would be 75, and the total is still 225, but it's now grouped slightly differently. So just an understanding of what that is. And so at the end of the day, this is what your balance sheet and your income statement would look like. Your balance sheet or statement of financial position is made up of assets and liabilities. Your liabilities are split into two types: debt and equity. Debt is money that is lent to the business and you pay interest on it. Equity is money invested in the business and they share in the profits. On the other side, you have your assets, and your assets are split into two: assets that one would normally have for longer than a year and less than a year. The ones you would have longer than a year are called non-current assets, and the ones that you would have less than a year are called current assets. And that's all your balance sheet, split into those four things. That's all it is. Your balance sheet is telling you the liabilities, where the money came from for the business, and your assets, where that money is sitting right now in the business. And then on the other side, you've got your income statement or statement of comprehensive income, and this just tells you your sales or any revenue that you get in, less all your expenses, which could be a variety of different things. So hopefully this has given you some insight into what the income statement is, what the balance sheet is, and how they link together. What we're going to be doing in the next video is we're going to be going through the income statement specifically, and we're going to unpack that in detail so you can understand what are all the elements of that income statement. So I'll see you in the next video behind my screen.